The best dividend ETF that you can go for is SCHD. It doesn't just have a great dividend yield, but it also has a fantastic track record of increasing its dividends over time, as well as increasing share price over time. But there's just one problem. This ETF is domiciled in the US. So if you are from countries like Malaysia and Singapore, you'll be slapped with a 30% dividend withholding tax whenever you receive dividends. For example, for every $100 worth of dividends paid out, Uncle Sam will take away $30, leaving you with just $70.
And that's just sad.
That's why an alternative is to invest in Ireland domiciled dividend ETFs. Like the name suggests, these ETFs are domiciled in Ireland. And because the UK has a tax treaty with the US, if you invest in them, you will get to enjoy a much lower dividend withholding tax of 15%. In this video, I'll be going through some of the best Ireland domiciled dividend ETFs that you can go for. As a bonus, I've compiled all this info into this super detailed spreadsheet, which you can download for free, link down below, yeah? Also, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. First up, we have 4 Ireland domiciled ETFs tracking the US market. The first ETF on this list is FUSD. This ETF tracks large and mid-cap US dividend stocks that have strong fundamentals and financial stability. Specifically, it chooses its holdings based on metrics such as dividend yield, cash flow margin, return on invested capital, free cash flow stability, return on equity, and debt to assets. Additionally, it also excludes companies that don't meet its ESG criteria, such as weaponry, military, and tobacco. This ETF has a Morningstar rating of 4 out of 5, a 0.25% expense ratio, 99 holdings, and a dividend yield of 1.85%. Interestingly, its top sector is information technology, then only followed by financials and healthcare. This isn't common, as you typically wouldn't expect fast-growing tech companies to also be paying dividends. But as a wise man once said, it doesn't matter whether a cat is black or white, as long as it catches mice, it's a good cat. Looking at its top holdings, I can't help but notice that it looks rather similar to Triple Q, as it holds many of the same tech names like Apple, Nvidia, Microsoft, Broadcom, and so on. Next up, we have UDWD. This ETF tracks the S&P Composite 1,500 stocks that have increased their dividends every year for at least 20 consecutive years, otherwise also known as dividend aristocrats. Besides that, this ETF also requires its holdings to be able to grow their capital as opposed to stocks that just pay dividends while the share price doesn't really go anywhere, like CICT. It has a 3 out of 5 Morningstar rating, 0.35% expense ratio, 133 holdings, and a dividend yield of 2.62%. As expected, many dividend aristocrats are in already mature sectors like industrial, consumer sectors, and utilities that peaked many years ago and now can't grow as fast anymore. These are companies like Chevron, Realty Income, Xcel Energy, and so on. The third ETF is HDLV. This ETF tracks 50 low volatility, high-yield stocks from the S&P 500. As the name suggests, all the stocks here have low volatility. Then, to make sure its holdings are well diversified, the fund manager also caps each sector to have at most 10 stocks, while also capping each holding to have at most 3% allocation and each sector to at most 25% of the index. This ETF has a rather low 2 out of 5 Morningstar rating, 0.3% expense ratio, 50 holdings, and a dividend yield of 3.53%. Its top sectors are utilities, consumer staples, and healthcare. And looking at its holdings, I have no idea what most of them are, and probably neither do you. But all you need to know is that they are just low volatility dividend stocks. Lastly, we have DGRW. And just in case you're wondering, yes, there's also a DGRW on the Nasdaq exchange. But the one that we are looking at here is the one that's listed on the London Stock Exchange. This ETF tracks US dividend paying stocks that have growth characteristics. For example, it needs to display growth in terms of return on equity, return on assets, gross profits, as well as cash flow. This ETF has a Morningstar rating of 4 out of 5, 0.33% expense ratio, 301 holdings, and dividend yield of 1.69%. As expected, its holdings are in the growth sectors such as technology, consumer staples, and industrials. So you again see many familiar names like Microsoft, Apple, ExxonMobil, and Nvidia. So out of these 4 Ireland domiciled ETFs, which is the best one to invest in? Obviously, I'm not a financial advisor, so I can't give you financial advice. But rather than looking at the dividend yield that can change according to the ETF price, personally, I think there are 3 metrics that we can look at. 1. Expense ratio to make sure we are paying as little fees as possible. 2. The dividend compounded annual growth rate or CAGR to see how well they can grow their dividends over time. And 3. What their historical returns were. Like, are they volatile and can they give decent returns? Obviously, while this can't guarantee future performance, it can still give you a sense of whether their stock picking criteria are effective or not when it comes to choosing the winners. In terms of expense ratio, I would say that all 4 ETFs have a decently low expense ratio of anywhere between 0.25% to 0.35%. But when it comes to dividend CAGR, for the 3-year period, some of them did quite badly as they had negative CAGR. That's because they saw a slight drop in dividend payouts back in 2022 when the Fed was aggressively raising interest rates. Though, interestingly, SCHD was unaffected by this, as it was able to consistently raise dividends year after year. Then, if you look at the 5-year period, only FUSD was able to do well, whereas the rest either gave negative returns or barely any growth. There's not much data for the 10-year period, as most of the ETFs here were launched within the last 10 years. Next, for annualized returns, both FUSD and DJRW were able to give the highest returns over the 3-year and 5-year period, which isn't too surprising as both of them focus heavily on tech companies. Meanwhile, UDVD and HDLV gave lower returns as they were focusing on other areas like consistent dividend growth and low volatility. So if we sum this all up, I would say that FUSD would be my top pick as it has the lowest expense ratio, highest dividend CAGR, while giving the second highest annualized returns. Okay, just in case you are wondering how to invest in Ireland domiciled ETFs like FUSD, just how you can do it in Interactive Brokers. First, turn on trading permissions for the UK markets by searching for Request Trading Permission. Under Stocks, click on Add or Edit button, enable United Kingdom. Then search for FUSD, click on the one that has LSE ETF at the back. Then just buy the ETF as per normal. Interactive Brokers is the best broker to use as it charges a super low fee of just $1.70 for the UK markets and also low fees for most of the other markets. So if you are interested, you can sign up to IBKR using my link down below. Next, let's look at Ireland domiciled dividend ETFs that track the developed markets. The benefit of investing in the developed markets is that it gives you geographical diversification. So you aren't just relying on just the US markets to do well. Not just that, they may also provide exposure to potentially undervalued markets and currency diversification, which can help to hedge against the volatility of the US dollar. So with that in mind, let's check out what we have. The first ETF here is FGQI. This ETF is very similar to its FUSD counterpart, where it also tracks large and mid-cap dividend stocks that have high yield, strong fundamentals, and financial stability. The main difference here is that instead of just holding stocks from the US market, it also has stocks from markets like Japan, UK, Australia, and so on. Though I have to admit, the US allocation is super big at 76%, but there's still geographic diversification nonetheless. This ETF has a Morningstar rating of 4 out of 5, an expense ratio of 0.4%, 226 holdings, and a dividend yield of 2.35%. Its top sectors are again in information technology, then financial and industrials. Likewise, you will also see many of the same names here, though their allocation is a bit smaller. Next, we have WQDV. This ETF doesn't just track high-yield, large and mid-cap stocks from developed markets, but it also excludes holdings that don't meet the ESG criteria, such as weaponry, firearms, tobacco, alcohol, gambling, fossil fuel, and so on. Basically, he's like a chill guy ETF lah. This ETF has a Morningstar rating of 4 out of 5, 0.38% expense ratio, 199 holdings, and a dividend yield of 2.6%. In terms of country exposure, this ETF is less focused on the US, but instead has higher allocation in other countries like Japan, Switzerland, UK, and Germany. Its top sectors are in technology, healthcare, and industrials, which means many of the top holdings are familiar names like Apple, Nvidia, Home Depot, and Cisco. So, which is better? WQDV has a slightly lower expense ratio as compared to FGQI, but when we compare the dividend CAGR FGQI has a better track record of increasing its dividends over the 5-year period with a 6.56% dividend CAGR as opposed to WQDV's almost non-existent dividend growth. Then, when it comes to annualized returns, FGQI slightly outperforms WQDV over a 5-year period. So if I had to choose a winner, I would go for FGQI as it has performed better. Next up, we have ETFs tracking the emerging markets. People typically invest in the emerging markets for their high growth potential, rapid economic development, rising middle classes, and underdeveloped sectors that are ripe for expansion. However, they also come with higher risks, such as political instability, currency fluctuations, and market volatility. So if this is something that you are okay with, here are 2 emerging market ETFs that you can check out. First, we have IEDY. This ETF is pretty straightforward. It just tracks the 100 leading dividend-paying stocks from the emerging markets. Though, the holdings also need to pass a few screening criteria, such as they must have a non-negative trailing 12-month earnings per share, their dividend yield must be greater than 0%, and the company must have paid dividends every year over the past 3 years. This ETF has a 2 out of 5 Morningstar rating, a super high expense ratio of 0.65%, 109 holdings, and an incredibly high dividend yield of 8%. Its top 3 countries are China, Brazil, and Taiwan, and its top 3 sectors are financials, materials, and energy. Like many of you, I don't recognize many of the holdings here, other than Evergreen, which accidentally got its ship stuck in the Suez Canal and caused a massive traffic jam. Next, we have EMHD. This ETF is similar to the previous ETF, where it also aims to track the leading dividend-paying stocks from the emerging markets, but with an added twist, and that is, they focus more on companies that have the lowest volatility. This ETF has a Morningstar rating of 3 out of 5, 0.49% expense ratio, 169 holdings, and a dividend yield of 5.8%. Similar to the previous ETF, its top 3 countries are China, Brazil, and Taiwan, while its top 3 sectors are financials, materials, and energy. So, which is better? Unfortunately, both ETFs perform quite badly in every area. One, both of them have very high expense ratio of 0.65% and 0.49% respectively. While the dividend yields look very attractive, the reality is this was caused by the share prices going down over the past few years. Besides that, both their dividend CAGR and annualized returns also saw negative growth. So for this segment, I would say that both ETFs are equally bad. But I wouldn't go so far as to say they are uninvestable. That's because while the emerging market is currently having quite a bit of trouble over the past few years, no thanks to China and many other emerging markets, if we look further back, there were times where the emerging markets outperformed the developed markets. So I guess it mostly depends on how bullish you are about the future of the emerging markets. Lastly, we have the all-world ETF, which basically invests in dividend stocks in both the developed and emerging markets. Though, in reality, the developed market portion takes up a huge 88% of the allocation, while emerging market only takes up the remaining 12%. This allows investors to benefit from the strength and stability of the developed markets, while also benefiting from the potential growth of the emerging markets. So, best of both worlds. First up, we have REITYD. This ETF tracks large and mid-cap companies, excluding real estate trusts, from both the developed and emerging markets, while also paying dividends that are generally higher than average. It has a 3 out of 5 Morningstar rating, a decent 0.29% expense ratio, 2,000 overholdings, and a respectable dividend yield of 2.97%. Its top 3 countries are the US, Japan, and the UK. And despite being an all-world ETF, its top holdings are all from the US, such as JP Morgan, ExxonMobil, and Home Depot. Next, we have GLDV. This ETF focuses on dividend stocks that are able to deliver positive return on their equity and cash flow from operations, while at the same time able to increase or maintain their dividend payouts for at least 10 consecutive years. This ETF has a rather low Morningstar rating of 2 out of 5, 0.45% expense ratio, 97 holdings, and a dividend yield of 3.87%. The top 3 countries are the US, Canada, and Switzerland, while the top 3 sectors are financials, utilities, and real estate. So between the 2 of these ETFs, I would pick REITYD as it has a lower 0.29% expense ratio, a lot more diversified in terms of holdings, and while its dividend CAGR is pretty low, it was able to make up for it by giving a decent 6 to 8% annualized returns. Alright, if we look at all the ETFs that we have picked, FUSD would definitely be my top pick. as it has a low 0.25% expense ratio, a rather good 5-year track record of growing its dividends, and a pretty attractive 3-year and 5-year annualized returns. Though, if you compare FUSD against the king of all ETFs, SCHD would still be the best ETF. However, since SCHD charges a 30% dividend withholding tax for non-US residents, FUSD would still be a good choice after accounting for all the fees. Also, if you are okay with sacrificing some potential returns for diversification, there's no harm in going for the developed market ETF, FGQI, or even the all-world ETF, VHYD. After all, the main criteria for investing in dividend ETFs isn't so much about the super high returns, otherwise you will go for growth ETFs already. Instead, it's about how well the dividends can grow as well as the stability of your investments. So, which one is your favorite ETF? Do comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.